It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at two interest rate sensitive sectors in the era of higher for longer. What is the best way to play it? I'm here with Steve Sosnick, Interactive Brokers Chief Strategist. Good to see you. Thanks for being here.
Great to see you too, Julie.
So let's get to the first of these, and that is real estate as a sector. Here being expressed by the XLRE, the ETF that tracks it. And this is definitely an interest rate sensitive sector. You can see it's gone kind of sideways over the past 12 months or so. Talk to me about why we're investing here, the hunt for yield.
In both of these sectors, you're talking about perpetually defensive type of sectors that are very much geared toward interest rates. In the case of real estate, it's interest rate sensitive on the way in and the way out. They borrow a lot of money, but they pay a high dividend typically. Real estate, though, has been very heterogeneous. There's certain parts of it that are blowing the doors off. There's other parts that just completely stink.
Right.
And I think I think that people are focused on the risky parts of it without necessarily noticing the more, the more healthy parts of it.
Well, I want to dig into that. But first, as we talk about the hunt for yield, do these companies does this group tend to only take off when rates actually start to cut, or do they anticipate it?
They should anticipate it, but and I think part of the problem is we've gone from anticipating a lot of rate cuts
that haven't come.
Right? I mean, we started the year looking at 6 to 7 rate cuts. We got as low as like basically 1. Now we're kind of back to 2. So that has this broader stock market has kind of shrugged it off because it's a good economy, it's fine. Real estate's kind of muddled along because they are so interest rate sensitive, so it hasn't really helped them out.
Gotcha. So let's then get to that other point you were making, which is that this is a diverse set of companies. You've got office, but you also have mall, and you have apartment, and you have data centers, and all different kinds of real estate owners. That's
the key there. I mean, I don't know that I would feel comfortable in investing in too many specific REITs because you really need heavy-duty analysis for that, and that's just that's not my bailiwick. And so I wouldn't want to propose that to anybody. But when you take a big basket of them, as we know, there's certain parts, residential is going crazy on the good side. Commercial is really stressed, and you've got everything else in between. So I think it's okay to be in a diverse sector as long as you have winners to help out the losers.
Right, exactly. And then also, this group, as we looked at that long-term chart, hasn't done so hot.
No, it's been kind of lousy, and that's why I'm thinking if you want to be in a sector that pays yield, this may be your better choice right now, comparatively, and we'll see the second part of it in a minute. But the underperformance is it's done nothing for the better part of 2 years.
Yeah, and then we always like to talk about what the risk could be, and that's the high rates stay high, and that you have more of that impact across that set of diverse companies, perhaps.
I will say the risks here should be relatively self-evident.
Yeah.
If the good sectors stop performing well, the good subsectors, I should say, stop performing well. Yeah, that can be trouble for everybody. How stressed do they get in terms of the higher rates? If people just really say, you know what, I'm on a buyer's strike, I can't afford to buy houses, I can't afford to move. That does have an impact, and not in a good way.
Although ironically, the one sort of subsector that's not really represented in the XLRE is like single-family homes to the same extent, right? It's apartments are in here, but residential is sort of underrepresented. It feels like in the XLRE.
It by definition, it kind of has to be because the only way to get
real estate investment trusts.
Exactly, it's my house, it's your house.
Right.
There's no way for someone else to invest in those. And you can get into the home builders, but that's not really what this covers. So it does really leave out the residential sector, except for multifamily.
Right, and then let's talk about the other group that we've been alluding to obliquely, the one that you would avoid, and that's utilities. And here I have to say, I feel personally attacked because I wrote about utilities in the morning brief last week and how they have been benefiting. This is a group that's up, more than 10% this year, which is part of the reason that you say, maybe it's a little much.
Well, that's it. I mean, let's put it this way. In some ways, I'm talking my own book in a bad way because I do own utility stocks. I've always had an allocation to them because I like the yield. But I think I think this is a manifestation of the AI craze that's gotten a little bit out of hand. There have been certain sub-pockets where this is what happens sort of in the end phases of a mania, is you start to look for all the different places where people haven't looked yet. Copper was one of them. We need to wire the country for all this power that we need. Well, utilities are the ones providing it. The problem for utilities their rate structure is pretty well fixed. That's the good side of investing in utilities. You know, they pretty much know what their costs are going to be unless there's an energy shock. They pretty much know what they can charge in rates, and you know, and then they pay a certain amount of that out in dividends. The problem here is it takes for, I don't know how long it takes to build exactly a new power plant. Depends on what kind you're going to build. So if you're piling into utilities as an AI play, it's going to take you years for that to pay off. Doesn't mean you shouldn't consider it. It's not part. It doesn't mean it shouldn't be part of the bull case for utilities in the long run. But on the other hand, a 10%, 12% rise like we've had this year.
Right.
It's a little much in a short period of time.
If you're waiting on capacity to be built out. You also say future discounting came too early. What do you mean by that?
What I mean is it takes, you know, however many years to build the power plant, and that's exactly what it comes down to. Yes, let's stipulate that AI will create demand for electricity. Let's stipulate that it's pretty hard to imagine demand for electricity shrinking in any meaningful way over the foreseeable future.
Right.
They're going to be the ones providing it, but how long, when, and under what cost structure?
By how much can it go up with the existing capacity?
Exactly.
Yeah. And then finally, you get nervous when boring sectors become exciting. And this is exactly what I wrote about in our Morning Brief newsletter last week, is that AI had succeeded in making utility sexy, which is not easy to do.
Yeah, that's the problem, and that, which is not to diss what you were saying. I wrote something about that along those lines as well. Is that, you know, the copper and utilities have become AI plays, but that in my mind is why this is one to avoid right now. It does, again, if you have it, don't sell don't sell them. I'm not selling mine, but I'm not buying any more up here because they got overextended, because the utility sector has more or less matched the S&P 500 on a year-to-date performance basis. Think about that. And this is the kind of environment when you have defensive sectors, it either means you've got sort of a retrograde economy or interest rates are going in your favor. Really, neither has happened, and yet the utility stocks went crazy. And
things could still continue to be crazy, right?
We've all seen this. Crazy can get crazier.
Yes.
So that's the risk. That is the risk to the negative.
But as you said, you have an allocation you just wouldn't be adding here, so you could still benefit from that.
Exactly.
And let's skip to this chart, which is a 3-year chart of these two. You've got the utilities in blue and real estate in purple, and this just again kind of more starkly portrays the underperformance of real estate.
Absolutely. In this part of the chart, this was, you know, sort of the end run of the COVID era trade, when you had zero interest rates and the markets were going up. They both did okay. Obviously, you know, there's other sectors that would be up here on the chart, but these both did, they more or less moved together.
Yeah.
And then we started to get into the rate hiking cycle in earnest. And the utilities, because they have a stable earnings stream, they sort of muddled along, and then you see here at the end how they popped up.
Well, and I guess like ChatGPT was right around here-ish.
Yes. But on the other hand, the real estate story got out of hand toward the end of 22, and we've never really come out of those doldrums.
Right.
So that's really where, and so that gap at the very right-hand side is what I'm talking about here.
Gotcha. All right. And so, and as you said, you do have an allocation in utilities, but you have one in real estate as well, I imagine.
Yep.
Thanks so much, Steve.
My pleasure.
Good to see you as always. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.